So when we have this cash flow, so the future cash flow of $13,000, so we had the 5 and the 4 and the 3 and the 1, we have to discount these back using a discount rate. So there's a couple of examples. We start off with an example that says we're going to use a 12% discount rate. So it gives you the present value factors. You won't get these on the test. It's just a conceptual idea. So that in the future, where you get the $5,000, using the discount rate of 12%, these dollars discounted back to their present value today, $4,465. So remember, when we use the discount rate, it takes our future value and it makes it worth less today. Now, once you do that, use the present value factors for this $13,000 worth of investments, worth of future cash flows is how I should have said that, and you discount them back to their present value. We have $10,425. Now, to get to net present value, what we have to do is we have to subtract the initial cost outlay, which we said was $10,000. So $10,000 minus $10,425, we have a net present value with a 12% discount rate of $425, positive $425. And we said any time that the net present value is positive, yes, it's a good investment for your client. Now, the next one gives us a discount rate, uses a discount rate of 15%. So if when we used the discount rate of 12%, the future values, when they were discounted back, were worth $10,425. Now, based upon your understanding of how this discount rate works, we've got the same $13,000 future value. If you have a higher than 12% discount rate, what's the present value of the $13,000 going to be? Is it going to be more or less than $10,425? It has to be less. It has to be less because we said the higher the discount rate used, the lower the net present value. So the present value of this $13,000 using a 15% discount rate is $9,920. So if your initial cost outlay was $10,000 and the present value of the future cash flow was $9,920, what's your net present value when we use a 15% discount rate? It's negative $80. What did we say about a negative net present value? Would you want to go through with that investment for your client? No, you would not. You would not. So it's those sorts of concepts that the test likes you to understand. No actual calculations. Thank goodness, right? Now, would you agree with me that somewhere between 12 and 15% is the discount rate in which the net present value is equal to 0? Would you agree that that had to happen? Because when we used the 12% discount rate, we had a net present value of $425. So just kind of guessing, because it's not a test question or anything like that, but what would you think that the discount rate to get the net present value equal to 0 is closer to? Is it closer to 12 or closer to 15? It's closer to 15. So this idea that the future values discounted back so we put in $10,000 into the investment. The future value discounted back to its present value of $10,000 gives you a net present value of 0. The discount rate that we used here, what is this discount rate? You don't know exactly what it is, and there'll never be a test question that says, you know, how do you how do you figure it out? Because you can't without a financial calculator. But it's closer to the 15 than it was to the 12. And I'm going to tell you what it is. It's 14.8%, because I know. The test loves this concept. When the net present value is equal to 0, the discount rate being used is the investment's internal rate of return. The investment's internal rate of return is the discount rate in which the future cash flows, discounted back to their present value, minus the initial cost of the investment, is equal to 0. Be careful. Sometimes students think this means you didn't earn anything. That's not true at all. What this means you earned is 14.8%. I'd love to earn 14.8%. How about you, right? So if the internal rate of return is greater than your client's hurdle rate is what they would like to earn or what they expect to earn, their expected return. If their hurdle rate was 10% and this investment has an internal rate of return of 14.8%, it is a worthwhile investment for your client. If the internal rate of return is greater than your client's hurdle rate, this is an acceptable investment for your client. So net present value is a dollar amount. The internal rate of return is a percentage. And there's something else about the internal rate of return I think that will help you. If you look at a bond, back to the bond teeter-totter. If you look back to this bond teeter-totter, when we have a nominal yield, let's say it's 10%, and we buy the bond at par, we pay $1,000 for the bond. We have 3 yields that are important. There's current yield, there's yield to maturity, and the last one is yield to call. And we'll do an example over and over of this in a subsequent section. But there's this idea, if you buy a bond at par, you have a nominal yield of 10%. That means your annual interest is $100 a year, $50 every 6 months, because bonds pay interest semi-annually. The current yield is the annual interest divided by the current market price, and since we're balancing here on the teeter-totter, we're buying the bond at par, your current yield is 10%. Yield to maturity takes into account, did you pay par for the bond, or did you pay more or less than par? So if you paid par for the bond, the yield to maturity is 10% as well. And yield to call, if the bond could be called at par, you paid par, your yield to call is also 10%. But when you buy a bond that's trading in the secondary market at less than par value, you buy the bond at what is called a discount. So if you buy the bond at less than par, for example, let's say you pay $800 for this bond. The nominal yield, the tattoo on my chest, that never changes. The interest payments are always $100 a year, 10% of par. The current yield is going to be more than 10%. Current yield would be annual interest divided by current market price. Yield to maturity is going to be even more than the current yield because it's going to take into account not only the $100 that you get every year, but the fact that when you bought this bond, you paid $800, which is $200 less than par value. So yield to maturity takes into account the fact that when the bond reaches maturity, you're going to get $200 more than what you paid for the bond. So this whole discussion was because I really need you to understand, when you buy a bond at par value or you buy a bond at a discount, the most important yield for your investor to consider is the bond's yield to maturity. If they were to buy the bond at $800 today, hold the bond until maturity, the bond matures, let's say, in 10 years, because how long until maturity, of course, is part of the formula. They're going to have a yield to maturity, let's say it's 13.3%. The bond's yield to maturity is the bond's internal rate of return. A bond's yield to maturity is the bond's internal rate of return. So, just like we said with net present value, the discount rate being used to get a net present value equal to 0 is the investment's internal rate of return. A bond's internal rate of return is its yield to maturity. So it doesn't mean that they don't earn something. It actually tells you what they earn over the investment, internal rate of return. So a couple of questions there on the time value of money, on net present value, on internal rate of return. You have to feel comfortable with the concepts, not the math. Expected return. Expected return is also sometimes called mean return. To figure out the expected return, you need to know the probability of earning a certain return. So let's say you were 10% likely to earn 20% and 50% likely to earn 2% and so on and so forth. You multiply those out and you add those together and you get the investment's expected return. The expected return doesn't promise anything. It's just what you would expect to earn. There are other quantitative methods, other descriptive statistics that we need to have a basic understanding of. So back to some basic math principles. Mean. Mean means average. The mean of a list of returns is the average of those returns. So if you had 10 different returns, you'd have to add them all up and divide by 10. Or if you had 3 different numbers, you'd add them up and divide by 3. So whatever number you divide by is however many numbers that you had within the question. So the test likes you to understand that mean does not measure dispersion. It doesn't measure how spread out numbers are. It just tells you what the average of the numbers are, or the average of the rate of returns. You need to know what median is. Median is the middle number. Median also does not measure dispersion. Median does not measure dispersion. So it's just the middle of the returns, or the middle of the numbers. Mode. Mode would be the number or the return that occurred most frequently. Mode. It also does not measure dispersion. Range is the difference between the highest and the lowest return, or the difference between the highest and the lowest number. Range. Standard deviation. The concept of standard deviation, it is the mean of the means. Test question. What's the mean of the means? Standard deviation. It sounds kind of weird, right? It's used in probability theory. It's the square root of a data set's variance. It is the average difference of the scores from the mean of distribution. It measures how far they are away from the mean. So mean is average. So it measures standard deviation measures dispersion, test question. It measures volatility. It measures how far or how close, depending on the standard deviation, are the returns to the average. How far are the returns to the mean? So if you have a low standard deviation, it shows that all of the data points are close to the mean. All the data points are close to the mean. If your investment has a high standard deviation, it shows that the data is dispersed, that there's a large range of values. The higher the standard deviation, the greater the dispersion from the mean. The bell-shaped curve shows a normal distribution. So if you're given 2 choices on the test, there's usually, it's some sort of a chart or a table, and you have to pick which one of these would be better for your client. Generally speaking, the portfolio that has a lower standard deviation, has lower risk, is a better choice for your client. Standard deviation provides a quantified estimate of the uncertainty of future returns. Standard deviation. Beta factors. A beta factor is a coefficient measuring a stock's relative volatility or risk as it relates to the market as a whole. So beta factors measure a stock or portfolio's volatility related to the market as a whole, the S&P 500. So if the beta factor is equal to 1, then the portfolio or the stock moves with the market. The S&P 500, but they'll say with the market, beta factor of 1. If your client is comfortable with risk and wants to take on higher risk investments, you'd want to pick investments that have high beta factors. Beta factor of greater than 1 would tell you that the investment is more volatile than the S&P 500. Conservative investors would want to have securities that have low beta factors, so defensive issues, things that resist market cycles, would have a beta of less than 1. So if the market was down 10%, your client's stock's only down 2%, so defensive. Growth stocks would have what? High or low beta? Growth stocks would have high beta. Growth stocks would have high beta. The Sharpe ratio and beta are both methods used to measure risk-adjusted return. So the concept of beta, how a portfolio moves versus the S&P 500. And then we have a ratio that's important called the Sharpe ratio. So Professor Sharpe, who now manages money, I think, created this. The Sharpe ratio helped him go on to win a Nobel Prize in 1990. The Sharpe ratio allows us to see if the higher returns found in a portfolio are the result of better portfolio management or too much additional risk. So Sharpe ratio helps us to measure, remember this is always on the test, risk-adjusted return. Risk-adjusted return. So if I give you 2 portfolios and we're trying to decide which one's better for our customer, the rate of return for portfolio A is 16% and the return for portfolio B is 12%. A is 16%, B is 12%. Which one would you rather have? Oh, A. Everybody would rather have A, right? The Sharpe ratio is going to take into account 2 things that haven't been accounted for yet here. First, we're going to subtract out what's called the risk-free return, which is the rate of return on a treasury bill. And we're going to divide that by the standard deviation of the portfolio or of the security. So if the risk-free return is 5%, so we're going to subtract out the 5% for both of these. So portfolio A, we have 11%. Portfolio B, we have 7%. But we're going to have to divide into this the standard deviation of portfolio A and the standard deviation of portfolio B. So if portfolio A has a standard deviation of 9 and portfolio B has a standard deviation of 5, what did we say about the standard deviation? Which one's generally better for the client? The higher deviation or the lower? The lower. The lower the standard deviation, the closer the returns are to the mean, to the average. So when we figure the Sharpe ratio for portfolio B, we have 1.22. And the Sharpe ratio for portfolio A, 1.22. And the Sharpe ratio for portfolio B is 1.4. When you're comparing using the Sharpe ratio, what you want is the higher Sharpe ratio. So even though when we started this off, you probably thought the portfolio A was better, once we subtract out the risk-free return and divide by the standard deviation, the Sharpe ratio shows us that, in fact, portfolio B is a better choice for your client. So I would know the formula for the ratio. Actual return of the portfolio or of the security minus the risk-free return divided by standard deviation. The alpha coefficient. Alpha is a measurement of performance on a risk-adjusted basis. Alpha takes the volatility of a investment, maybe it's a mutual fund, and compares its risk-adjusted performance to a benchmark index. If the fund's return is more than that of the benchmark index, that difference is called the fund's alpha. So we said beta measured the portfolio or the securities volatility related to the stock market as a whole, so as to the S&P 500. Alpha helps us to measure the value that is added, let's say, to a mutual fund by the management of the investment advisor. Did they do a good job? Did they bring value to it? Or did they do not such a good job and actually have a negative effect on the return? So alpha is used to describe an abnormal rate of return on a fund. It could be a portfolio. It could be a single security that's in excess of the return that is predicted by an equilibrium model, such as the capital asset pricing model. If the capital asset pricing model had estimated that a portfolio should earn 7% based upon the risk of the portfolio, but the portfolio actually earned 10%, then that portfolio's alpha is the 3% that's in excess of what was predicted by the capital asset pricing model. So if the capital asset pricing model predicted 7%, but the actual return was 10%, the alpha is the 3% that are different. It's the 3% that is different. There are 5 technical risk ratios. These are statistical measurements that are used in modern portfolio theory. The 5 measurements include beta, the standard deviation, R squared, the Sharpe ratio, and alpha. All of these statistical measurements are intended to help investors determine the risk-reward profile of an investment. When applying these measurements to the performance of a mutual fund, alpha is used to measure the value that the investment advisor adds or subtracts from the fund's return. If the alpha is positive, it means that the mutual fund outperformed the benchmark index. So if you had a 4 alpha, it would mean that the mutual fund outperformed the index by 4%. If the alpha was -1, it would mean it underperformed the index by 1%. So a couple of questions on these statistical forms of measurement. The test is going to want you to have an understanding of the different types of risks that your client is going to be exposed to by investing in the securities that you will be recommending. So there's 2 broad categories of risks. There are those that we call unsystematic risks, and there are those that are systematic. The categories that I'm going to place the different types of risks in, as far as unsystematic and systematic, come directly from the outline as published by the North American Securities Administrators Association. Those are the people that forgot how to speak in English that write your test. So even though you might sometimes feel like, oh, that goes somewhere else, we're just going to place it where the outline placed it, and then, of course, learn about it. So I expect the potential for a question on each of these types of risks. So we're going to start off with unsystematic risk. Unsystematic risk is stock specific. It is risk that is related to the actual security investment itself. If you were to put all of your money into your company's stock, let's say you put all your money into Enron because you used to work there before they went broke and now you got nothing, that's unsystematic risk. It is risk that can be avoided through diversification. So unsystematic risk, stock-specific risk may be avoided by diversification. So there are 4. The first one is business risk. Financial risk, the risk of default, falls within this category of business risk. So don't put all your money into one company's stock, because if it goes belly up, you're in big trouble. You'll have nothing left. So you can avoid this type of risk by diversification. Now, you could lose your money, the stock price could plummet, not just because the company goes broke. There could be something else that the company did that would still be a type of business risk. Maybe the automobiles that they manufacture catch on fire, or maybe the tires that they manufacture blow up, or maybe the kids' toys that they manufacture are poisonous. There's all those kinds of things that you can think about. So business risk related to that specific stock itself, and you can avoid business risk by not putting your eggs in one basket. Stock-specific risk. So they're going to give you a question on the test where something has happened, and you'll have to determine which of these 4 types of risks is it. So business risk related to that company itself. Regulatory risk. Also stock-specific. Regulatory risk is a type of risk that may be eliminated by diversification. But regulatory risk has to do with either a change in tax laws, regulatory risk, or it is something like a company's being investigated for a violation of antitrust laws. There's a lot of that. As an economy, we don't want any one company to become a monopoly. So Microsoft faced a lot of antitrust lawsuits along its lifetime. Other companies have similar situations. Whole Foods is a natural food store that bought a smaller company called Wild Oats, and there was a whole investigation into antitrust violations there. If the New York Stock Exchange should sell itself to another person or should merge with another company, as might be the case here one of these days, that has the potential for being investigated for violation of antitrust laws. So regulatory risk, also known as legislative risk. So stock specific. Political risk. Political risk, I know what you're thinking. I know what you're thinking, and I'm not even going to say it. It's not about the politics here in the United States. It's having your investment in another country that has political turmoil. It's a geographic type of risk. It can be eliminated by having your assets exposed to lots of different countries, not just all of your assets in Greece. That would not be a good idea. So political risk. Terrorism is also an example of a type of political risk. Liquidity risk is the last of the 4 unsystematic risks. Liquidity. How easily do you need to be able to turn this investment into cash? So money market instruments are very liquid. They're the most liquid next to cash that we have. Stocks are liquid too, though. If you don't want to have your shares of stock anymore, you just sell them at the next market price and you get out. Open-end mutual fund shares must be redeemed within 7 calendar days, so those are liquid as well. Direct participation programs, those are a type of limited partnership. There is no secondary market currently for limited partnership units. Those are illiquid. So those present liquidity risk. So if your client is worried about that, don't sell them DPPs. Do not get them into a limited partnership. So limited partnerships have liquidity risk. So all of these, so a house might have liquidity risk in the housing market that's been around for a while now. I guess it depends upon where your house is, though, but liquidity risk, harder to get your money out of. All of these 4 can be avoided by making sure that you don't put all of your money into any one of these. So don't put all your money into one company's stock. Don't put your money into all of one country's investments. Don't have them all in one country. Political risk, regulatory risk, tax law changes, antitrust regulations, and liquidity risk. All of these can be avoided by diversification. Systematic risk cannot be avoided by diversification. So systematic risk the economy is a system. And when you're in the system, there's no getting away from these three types of risks. Diversification does not help to eliminate systematic risk. So just having lots of different company stock does not help eliminate systematic risk. So there's three systematic risks. Market risk, interest rate risk, and last, inflationary risk. So you need to know all three are types of systematic risk and that they cannot be avoided simply by diversifying. Now that have different classes of assets, that helps to eliminate some systematic risk, have some stocks, have some bonds, have some insurance products, have some real estate, have some cash. That will help a little, but nothing will avoid systematic risk. If you're in the stock market, so you have $500,000 in your retirement account, lucky you, you're one of the few Americans that has saved. And the stock market closes down 20%. Is your portfolio going to be down? Absolutely. That is what we call market risk. When you invest in the stock market, the market goes down, the market goes up, the market goes sideways. You cannot, in the stock market, avoid market risk. So it's in the system. Same thing with interest rate risk. As interest rates change, it is true that it affects some types of investments more than others. But the whole entire economy as a whole is affected by interest rates. So that the risk that we have as far as when interest rates change, it's a type of systematic risk that really cannot be avoided. If I was to say, which of these two has more interest rate risk, a bond or common stock, what are you going to answer? Of course, the bond has more interest rate risk. Anytime you have an investment that pays a fixed interest payment, like a bond does, where the nominal yield is a percentage of par, when interest rates change, we talked about the teeter-totter effect. As interest rates go up and down, the price goes up and down inverse to the interest rate change. When interest rates go up, the yields go up. If interest rates go down, the yields on the bonds go down. We talked about that. So bonds have more interest rate risk than common stock does, most definitely. But as we mentioned before, if the Federal Reserve should meet and should decide to lower interest rates, that appears bullish to the stock market. So the stock market likes it when interest rates are lowered or when interest rates are low. So interest rate risk, it's a type of systematic risk. The last of the three is inflationary risk. I don't know about you, but I would be really happy if when I went to the gas pump, I could get gas for $1.80 again. But I guess that's never going to happen. So inflation, you can't avoid it. There's no way around it. Over time, things get more expensive. So this rise in the prices of goods and services, inflation. It's true that some types of securities have more inflationary risk. Fixed annuities, for example, have huge amount of inflationary risk. If your client puts their money into a fixed annuity, they're promised to be paid 3% over the next 50 years. Their money is going to grow, yes. But if inflation outpaces the earnings in that account, what's their purchasing power going to do? Go down. So inflationary risk. Fixed income securities have inflationary risk. If your client's worried about that, then they should buy common stock or a variable annuity. So a hedge against inflation. Historically, the stock market has at least kept pace with inflation. You can't guarantee that it will into the future, but in the past, at least, it has kept pace with inflation. So fixed income securities have inflationary risk. But once again, inflationary risk is within the categories unsystematic or systematic. It's systematic. It's in the system. There's not one person walking around that can get away from the fact that there's this general rise in prices over time. So I would expect a couple of questions on systematic risk, a couple of questions on unsystematic risk. The test does like these concepts. Opportunity cost. There's always two roads to travel in life. There's the safe road, the one where you could earn what is called the risk-free return, which is the rate of return on treasury bills. And remember, I told you, we're using a rate of return on treasury bills that's more than 0. Let's say it's 3%, just to make up something. There's the safe road. And then there's the riskier road you could take. Path B. Anytime you choose the more aggressive choice and you have a rate of return that is greater than the risk-free rate of return, you won, you're happy, and you have a 0 opportunity cost. Anytime the investment that you chose had more risk but yielded you more than the risk-free rate of return would have, then you've won. Your opportunity cost is 0. If, however, the path that you chose, the riskier path, yielded you a rate of return of 1% instead of the 3% that you could have earned if you had gone the risk-free way. So if your rate of return, the riskier path, yielded you less, the risk-free return is greater than what you earned, your opportunity cost is what you missed out on. It's the 2%. So here you lost, you're not so happy. So it's the 2% that you could have earned had you put your money into the risk-free return. So you're either going to see this as a percentage, or you're going to see this question as a dollar amount. So let me give you another example. So it says that choice A would have yielded you $90, but you went this way and you earned $120. You earned $120. What's your opportunity cost? 0. None. You're happy. You won. You beat this other choice. If instead the path that you chose, you only earned $50 where you could have earned $90, the difference is your opportunity cost. Your opportunity cost here is $40. So something like that. There's one other way that they could do this opportunity cost question. They could say that you have $5,000 and you have two choices. You could invest the $5,000 and earn 5%, or you could take your family to Disneyland for a week. So you go on vacation. What's your opportunity cost? 5%. But the memories are priceless. Go on vacation, by all means, go. So opportunity cost. Obviously, if you didn't invest the money, then whatever it is that you could have earned, that's what you've lost by taking a vacation. But we could all use more vacations. Couple of questions there. Reinvestment risk is a risk that you have anytime you have an investment that reaches maturity. Reinvestment risk. Bonds are a type of a debt instrument that when they reach maturity, you get back your par value and you have reinvestment risk. You might have had a municipal bond that was paying 7%, and when it reaches maturity, the muni bonds were paying 2%. So you have reinvestment risk. So bonds have reinvestment risk. Another item that tends to be on the test is a bank CD. So there are certain instruments that you can buy at the bank that are not securities. This you can actually buy from the bank teller, not a security at all. So a bank CD, you tie up your money for 6 months or 12 months or 3 years or 5 years or what have you. It's true you can get out your money early, but there's generally significant penalties for doing so. So usually you put it in and you leave it in there for the year, let's say. So when the CD matures, if interest rates have gone down, you have reinvestment risk. Maybe the next investment, the next CD you put your money in won't be paying as much as this one was. So anytime you have an investment that reaches maturity, a bank CD is not a security, but it's definitely a concept on the test. Capital structure, including liquidation if a company goes broke. There's a chart of what is called seniority. In the event that a company goes broke, who gets paid first and who gets paid last in the event of a corporate liquidation? So the bottom of the barrel, if you will, the very bottom of the cup, all the way down here is common stockholders. Common stockholders, in the event of a corporate liquidation, they get paid last. They're what we call a residual claim on assets. So who gets paid first? The IRS, of course. They get paid first. Then we're going to have secured bondholders. They get paid. Secured bondholders. So bonds that are secured are backed by some sort of a collateral. The most common type of a secured bond is a mortgage bond. So the test might say mortgage bond. You need to know that that is a type of a secured bond backed by real estate, so land or a building. So if the company goes broke, they have to sell the building to pay off the mortgage bondholders. So the IRS gets paid first, then secured bondholders, then unsecured bondholders. These are what we call debentures. Debentures are unsecured bonds, not backed by anything but the full faith and credit of the company. So debentures would get paid next. Then preferred stockholders would get paid. And last but not least, if the company went broke, is the common stockholder. Sometimes we'll see reference to what is called a senior security. Senior securities are any securities that are above common. So senior securities include preferred stock, debentures, and secured bonds. Those are senior. They're senior to common. Common is the junior claim. It's the residual claim on assets. It's the bottom of the barrel. So in the event of a corporate liquidation, this would be who would get paid: IRS, secured bonds, debentures, preferred stock, and common. That concludes our discussion for economic factors and business information. Make sure that you take and do well on the section exam. Your goal is to get to 90% or better on every exam within this course. I do urge you, however, do not take the same exam 3 times in a row and get 100% on the third try and think that you know it. Because I'm telling you right now, you memorized your answers. So what I have found over all of the years of doing this, which I literally started doing this with my parents when I was 2, is that the first time you take one of these quizzes, that's an indication of your level of understanding. So if you get a 60 the first time, that's about how much of it you understand. So you either want to review the video, or you want to wait a few days and come back to it after having maybe studied your notes. But just taking it 3 times in a row is not going to get you to the level of understanding that I need you to be at to pass this test. So practice your section quiz, but give it a few days before you attempt it again. Good luck.